Good morning, everybody, and welcome to the full year results for Carclo for the year ending 31st March 2026. Just a process point first, you can ask a question at any time through the presentation by clicking on the Ask a Question button on the top right of your screen. We'll come back to it at the end and do Q&A at the end of the presentation. First of all, some introductions. My name is Joe Oatley. I'm the Chair of Carclo. To my immediate left, I've got Frank Doornbosch, the CEO, and to his left, Ian Tickias, the CFO. And what you'll hear this morning is another year of delivery for Carclo. Frank's going to give a little bit of a reprise on the journey we've had to get here before Ian takes you through the detail of the results. And then importantly, Frank's going to come back and talk through Precision 2030, which is our growth plan going forward, where we take the company from here, where the growth is coming from, and why that's going to create shareholder value. With that, I'll hand over to Frank.
Thank you, Joe. So good morning, and thank you all for joining. Yes, we are proud to present the results for the year ending the 31st of March 2026 and give you a first conversation about Precision 2030. It is a live webcast, so if you have a question to ignite the conversations after the presentation, please put them into the chat as we go along and we'll get there at the end. Here is how we will use the next half hour. I will start the journey, the 4 years from FY22 to FY26, and why we deliberately made the group better rather than bigger. Ian will then go through the financials, including the targets we have met ahead of schedule. I will come back to Precision 2030, our plan for the next phase, and how we grow from there. You will see 4 targets on the screen. These are the Precision 2030 targets, the framework for everything that follows. Revenue compounding above 8%, net debt below half times EBITDA by FY31, keeping our return on sales at and above the 10% through the cycle, and our return on capital at or above 25%. So let's start with how we got here. FY22 to FY26 spans 4 years, and those were 4 years of deliberate choices. None of what you will see in these numbers has happened by accident. Every step was chosen. Let me be clear about the top line. Revenue fell, and most of it was by design. One piece wasn't. The major design engineering contract that was cancelled in FY23, which we informed you about, as our customers' demand fell away at the end of the COVID period. The rest, we chose. We completed the asset revitalization back non-core manufacturing because the discipline we've set ourselves was a simple one. We concentrate on the work we are adding real engineering value and can genuinely excel. I mean, we have stopped competing for work that we can't. Look at the core we kept. Our strategic manufacturing portfolio delivered a compounded average growth rate of 4% right through the reset. And look what the discipline did to the quality of the business. Return on sales up from under 5% to 11%. Return on capital employed from 9.5 to over 29. Net debt to EBITDA down from 2.5 times to 1.3. And cash from operations up from under 7 million to 12. The business is smaller, but it is considerably better. And that was a choice that we made. This wasn't one big move. No one big red button we could press to solve it. This took hard work and clear strategic choices. We relocated head office to London and strengthened the leadership team. In CTP, our Precision Plastic Solutions division, we globally stopped our short-run business, and as a consequence of that choice was the closure of our dairy site in the US. And when we improved our asset utilization and effectiveness, We were able to concentrate our work and our talents in the US in Pennsylvania. We standardized our global manufacturing network, enhancing flexibility, and is currently a big asset in these times of geopolitical uncertainty. In specialty, our Precision Metal Solutions division, we invested in machining technologies at both Bruntons in the UK and Jacquetie in France. We opened new routes to market and entered into adjacent segments that also demand extreme reliability. Specialty has delivered a compounded average growth rate of its revenues of 14% over the past 4 years, with margins held. This is the blueprint of the group. And the proof is not only financial. We've also built a safer company over that period. Our incident frequency ratio per 100,000 hours has dropped nearly 75% from 2.7 to 0.7. We also became more sustainable. Our carbon intensity per million of revenue more than halved due to the efficiency improvements and moving towards CO2 neutral energy supplies. And we use our assets harder and more effectively. And yes, I'm extremely proud to say that the Carclo team has built a better, not a bigger, company in nearly all aspects. With that in mind, let me hand you over to Ian for what the numbers confirm.
Thank you, Frank, and good morning, everybody. Today, I'll take you through the financial performance for FY26 and explain what the numbers tell us about the continued transformation of the group. Overall, this has been another year of strong operational and financial progress. We have continued to improve the quality of our earnings, increased profitability, strengthened our balance sheet, and delivered another year of solid cash generation. Importantly, both return on sales and return on capital employed are now ahead of the medium-term targets we originally set in FY22. That reflects several years of sustained, disciplined execution towards reaching and exceeding those targets. Reported revenue reduced year on year, although this needs to be viewed in context, which I will come back to on the next slide. Our underlying business remains resilient and continues to generate higher quality earnings. Cash generation remained strong throughout the year. EBITDA growth largely offset the normalization of working capital, while net debt leverage remained well controlled despite completing our financing and making a one-off 5.1 million contribution to the pension scheme. Overall, this represents another year of improving financial quality across the group, demonstrated by the growth in earnings per share. Turning now to revenue. Our strategic focus remains firmly on moving from volume to value. Rather than pursuing revenue growth at any cost, we continue to prioritize higher value programs, stronger margins, and better long-term returns. Around 2.6 million of the reduction relates to foreign exchange translation, while H1 FY25 also included revenue of 2.2 million from products that have since been exited as part of our portfolio reset. Within design and engineering, revenue was lower in the US, following the completion of several significant automation and asset revitalization programs delivered during FY25. Meanwhile, manufacturing solutions continues to perform well, driven by exceptional demand in aerospace across both civil and defence markets for our specialty business, while CTP manufacturing solutions revenue was in line with prior year. Taken together, these factors demonstrate exactly the type of portfolio evolution we have been targeting. Discipline is clearly visible in our margin performance, which we have grown to 11% operating profit margin through self-help activities that delivered sustainable margin improvement across the business. Operational improvements, such as reducing waste, improved materials management, and better asset utilization, have helped reduce operating costs. Our commercial discipline has continued to enhance product mix. We have also successfully absorbed inflationary pressures during the year, holding cost increases below inflation wherever possible and through disciplined procurement and continuous efficiency initiatives. The combination of operational excellence and strategic portfolio management continues to expand margins despite the challenging external environment. Looking specifically at CTP, we continue to see consistent improvement in operating margins despite the revenue headwinds I previously mentioned. Having completed our planned exit from short-run, lower-margin work in the U.S., capacity is now directed towards higher value programs, and underlying manufacturing solutions revenue remains broadly stable year-on-year. Overall, the CTP business is now more focused, more profitable, and higher quality business. The Specialty division has had an outstanding year. Revenue increased for the third consecutive year, driven primarily by sustained aerospace demand across both civil and defense sectors. Importantly, this growth has also been accompanied by further improvements in profitability. The combination of strong market demand, improved operational performance, and disciplined customer selection continues to position Specialty as an increasingly valuable contributor to group earnings. Turning now to cash generation. Cash management remains a strength and a priority of the business. Underlying EBITDA growth translated into strong operating cash generation during the year. Working capital has moved towards more normal levels following our refinancing. Annual pension contributions were in line with expectations, and while the separate 5.1 million one-off contribution was completed as part of that refinancing rather than from operating cash flows. Overall, the business continues to demonstrate excellent cash generation and conversion and strong financial discipline. Moving on to tax. Our reported effective tax rate improved significantly during the year, reducing from 67% to 44%. It is important to take a moment to understand the effective tax rate, as it should not be interpreted as an indication of higher taxation within our operating businesses. Our overseas operations remain profitable and are taxed broadly at normal local taxation rates. Additionally, there is a tax cost to moving cash internally across the group. The final element that drives the group effective tax rate remains structural. These include the U.K. financing costs and corporate overheads that currently exceed U.K. taxable trading profits. As our financing costs continue to reduce and U.K. profitability increases under Precision 2030, these structural items are expected to unwind further. Turning now to the balance sheet. During the year, we successfully completed our refinancing and established a new banking relationship that provides stability and flexibility for the business. Net debt increased year-on-year, primarily reflecting two principal actions. Firstly, the normalization of working capital following the refinancing. Previously, we had the benefit of short-term supply finance agreements with some of our U.S. customers, which has now ceased following our new financing arrangements. Secondly, the one-off 5.1 million pension contribution made during the year. Our long-term objective remains unchanged. We continue to target net debt below 0.5 times EBITDA by FY31, and we remain firmly on track to achieve that ambition. Finally, turning to pension. As we continue to make significant progress in reducing the pension risk and improving the long-term sustainability of the scheme. Most importantly, the cash burden of the scheme continues to fall. Pension cash costs now represent approximately 19% of underlying EBITDA, compared with almost 30% a few years ago. The pension scheme therefore becomes progressively less of a financial constraint as profitability continues to improve. To conclude, FY26 represents another year of meaningful progress. We have improved margins, increased profitability, successfully refinanced the business, and reduced the pension risk. Perhaps most importantly, the quality of our earnings continues to improve as our strategy shifts the business towards higher value markets and stronger returns. The financial foundations of the group are considerably stronger than they were a few years ago, and we believe the business is well positioned to continue delivering against our Precision 2030 ambitions. Thank you very much, and I will hand back to Frank.
Thank you, Ian. So that is the foundation. The real question is, what are we going to do with it? And that's Precision 2030, our plan for growth. A reminder of what Carclo is, because it shapes where we can grow. We engineer precision solutions for highly regulated markets. What sets us apart isn't a single machine. Plenty of firms can mold or machine a part. It's how we work. Alongside the customer, solving the hard engineering problem with them. Fluent in the qualification and regulations these markets demand. And precise and consistent at volume every time. The molding, machining, welding, printing, and assembling are how we deliver. The skill is putting them to work reliably and being agile enough to move when a customer needs us. We're operating in two divisions. CTP in the plastics, precision plastic solutions, and specialty in the precision metal solutions. 11 sites, 6 countries, 3 continents. And 3 end markets where there is no tolerance of getting it wrong. In life sciences, we focus on the in vitro diagnostic consumables and reagent systems. In drug delivery systems, on auto-injector pens and inhalers. And we added a new focus, being pharmaceutical packaging and closures. In aerospace, we create mechanical flight control cables, machine components around safety mechanisms and streamline wires. And in safety and security, we focus on precision gears, head and face protection, and sensing and optical solutions. Here is why this platform is worth growing from. We don't sell finished medical devices. We make the precision consumables that run on our customers' diagnostic analyzers and the precision auto-injectors and pens that deliver life-critical medicines dose after dose. 6 of the world's top 10 in vitro diagnostics companies rely on us, and our average tenure with them runs into decades. That depth of relationship is earned, and it places a real obligation on us. When our consumable is specified within the diagnostics platform or a drug delivery device is approved, our customer is building their product and their own regulatory approvals around us. They are trusting us to perform every time, because changing suppliers would mean revalidating and reapproving the whole project. So our job every day is to be worth that trust on quality, on supply, and on consistency. This is exactly the same in aerospace, where the qualification is earned from scratch and a part that stays on a platform for its entire life. That trust is what protects the business. And this year, we have signed a 5-year life science renewal and a 3-year aerospace renewal. And a commitment like that runs both ways. Long tenure customers, deep technological integration, and a business that earns its position by performing. Precision 2030 is built on 2 pillars. Expand to carry the growth and innovate to make it durable. Together, they target organic revenues growth compounding above 8%, while we bring down the net debt below the half times EBITDA by the end of FY31. Both pillars built on the platform the turnaround delivered. We grow from a position of strength, and the bolt-on acquisitions in the later years are upsides of these targets, and they're not in the base plan. Expand is the main driver of revenue growth, and it comes in 3 moves. First, deeper with the customers who already trust us, more programs and more value per component. Second, into adjacent segments where the demand and regulations are moving our way. GLP-1 drug delivery, the pens and auto-injectors between the weight loss and diabetes therapies, pharmaceutical packaging, wearables, and veterinarian care. And for our metal precision, we're exploring maritime opportunities. Third, geographies we've underserved, like for CTP, the many life science players across Asian Pacific. An example for specialty is the growing Southeast Asian aerospace hub in Bangalore in India. On aerospace specifically, the engine here is civil aviation. Build rates of the major commercial European programs are rising. And next to our traditional metal, cable, and wire business, we've expanded our machining capability to deliver more of that opportunity. Defense sits on top of that. And with NATO budgets rising, it's a genuine tailwind. But civil is the structural growth story, and defense is the upside on it. None of this are new grounds for us. It is growth where we're already strong. Innovate is a smaller number today, and deliberately so. Its job is to keep the growth defensible for years. Three kinds of proprietary advantages. First, technology. Competitors can't match easily. It's for in and on the body liquid silicone rubber solutions, micromolding, and importantly, our proprietary C-mold technology. The C-mold matters more than it sounds. It lets us produce production tooling in weeks rather than months, which means that we can take the customer's new program to market faster than almost anyone. And in this market, speed is a real commercial value. Second, materials the market is moving towards. Barrier vials and stoppers that replace traditional materials as regulation tightens. And thirdly, products that are platforms in their own right. Drug delivery engines, where the IP stays with Carclo, connected inhalers, and our sandbox for developing along outside partners. Innovate doesn't just add revenue, it earns us the right to be seen as an innovator. And that standing as much as the technology itself is what opens the door to the next tier of customers. Which brings me to the most important part of the change. What it asks from us as an organization. Growth needs a different mindset than a turnaround did. In the turnaround, leadership set the plan and the business executed it. In growth, it runs the other way. The team out in the market finds opportunity and the leadership role is to back them, to give them the resources and to clear the obstacles out of their path. We're moving from a responsive supplier to a value engineer, leading each conversation with the engineering problem worth solving. From protecting the base to actively seeking new demand, and from engineering to a brief to owning the IP. It is already underway. New people in our customer partnership teams and early progress in LSR, the inhaler platform, and the sandbox already has the first partners playing in it. Let me close with the outlook. 3 years ago, Carclo was a business facing significant financial and operational challenges. Through the sustained focus on operational excellence, we have addressed those issues, and today, Carclo has a strong foundation and a disciplined plan for sustainable growth. Market conditions across the group are currently mixed. In aerospace, demands remain strong, and with the additional capacity now in place, we're well positioned to benefit from sustained sector growth in both civil and defense applications. In life sciences, conditions are more varied. Parts of the portfolio continue to perform well, while the demand on certain diagnostic customers has been softer in the earlier part of this year. In particularly, a notably weaker respiratory virus season has reduced testing volumes across the diagnostics industry, leading some customers to adjust inventory levels, an effect we expect to be temporary. We anticipate demand strengthening as we move through the year, as a number of our new growth initiatives will come on stream, and accordingly expect trading to be weighted towards the second half and expect to deliver positive organic revenue for the full year.